conversation going with Varun Lohchab, who's the head of research institutional equities at HDFC Securities. Varun, good afternoon, and thank you for joining us on Closing Bell. You know, I was looking at your strategy note, and it's interesting because you guys were anyway saying that this is just a bear market rally, and now the market is willing to look at everything that it wanted to ignore in the month of April. But the big question is that, are you expecting a retest of the March lows?
So, we don't have a Nifty target as such, but if you look at, what we had attempted to do in this note and in our previous strategy note was look at the earnings impact on our coverage universe. And now for FY21, we are building in a 5% earning decline. What we were, quite amused to see was consensus is still building in low teen sort of earning growth for Nifty, which looks extremely difficult. So we have cut our FY21 estimates by 26%. And if I look at last week's close, Nifty was hardly down 20% from the peak, which means it had not even corrected for the earnings cut, which is going to be there in FY21. So therefore, clearly at those levels, the risk reward seems unfavorable. Market has corrected 6-7% from there, so which means now we have, corrected 25 to 30% from the top, which I think still poses some downside risk, given the fact that these earning estimates that even we have, consensus is way above, and we expect that Q4 and Q1 earning season will see sharp consensus earnings cut. But even for our estimates, we still see more downside risk than upside risk, given the fact that we have built in, lockdown getting over by mid-May and things normalizing by September end, which is looking like probably the best case scenario as of now. So if we have a second wave or any other deep issues in terms of the recovery not being strong enough, then the risks are to the downside to both FY21 and 22. So we believe probably, retest of the lows is possible, but we are still not, we believe that 40% correction from the top more or less captures most of the negatives. So we don't, we are not in an ultra bearish camp expecting a new low to be made, but possibly, I would say 8.5 to 9,500 would probably be the range. And then from here on, the pace of earnings recovery, once the lockdown opens and how fast things start normalizing, I think that would determine whether, we go to the lower end of the range or to the upper end of the range.
Varun, hi, good afternoon. So what's the portfolio call in that case? Raise cash levels, get into defensives, and even definition of defensive might change in this market. So what's the call now in terms of portfolio stance?
Exactly. So I think, defensive definition also keeps changing. So in this case, like consumer staples, we are underweight more, given where the valuations are and where the earnings we believe will end up. So it's probably not as defensive. It is far more defensive than a lot of other sectors, cyclical sectors, but still, the earnings were getting cut and valuations were very high. So consumer staples, we were underweight. Consumer discretionary, we are underweight. We are overweight, utilities, telecom, which are, classical defensives. We have added some weight in utilities. Telecom was already overweight. We have added a little bit of weight in insurance. We have trimmed banks after the rally, and anyway, given their index weight had reduced, we had to cut weight to kind of, bring down the model portfolio weight. Pharma, we are slight overweight. We are not chasing it aggressively, given very sharp rally in April. We don't see valuations being super attractive out there. So I think it's in a reasonable zone. So we are overweight, but a mild overweight. And in IT, which was another sort of semi-defensive, we have actually cut our weight a little after the sharp rally, as again, like consumer staples, earnings will see, moderation even in IT. So I would say telecom, utilities, pharma are probably more defensive than IT and consumer staples within the, the broad defensive portfolio. And consumer discretionary and autos, we are both, we are underweight in both of them. We are underweight metals, and we are underweight energy, which is essentially oil.
Oh, okay, Varun. So got that. I think your only three green sort of specs are telecom, as you mentioned, utilities and pharma. I got that. I just want to go back to the stance on financials where you said you've trimmed your weightage. Now, I think everybody's grappling with the same question. We all know there would be more NPAs. Nobody has a handle on just how much will this wave be. Any sense? I mean, you've been hearing commentary from various banks, Axis, IndusInd, and several others. What's the sense?
So, see, again, the commentary is right now managements also have, little idea in terms of how things will pan out, how long the lockdown will be. So, management commentaries as of now are obviously cautious and actually not giving much guidance because it's a very fluid situation. Banks have actually gone ahead and provided in Q4 itself. So, FY20 earnings have actually taken a big hit for banks because of huge provisioning related to COVID, which they have done in Q4. Now, again, the extent of provisioning is more a judgment call of the management, and therefore it has varied a little bit across the banks which have reported so far. I don't think it is, in a way reflective of their portfolio quality. Is more, assessment of how deep and prolonged the pain could be. So, Axis went and actually made a big provision. IndusInd has also made. We are awaiting some of the other big bank results to kind of see the picture. But the way we are approaching banks is, we are just saying the force in the top 3-4 names. We don't have any second-run banks in our model portfolio, and the top ones, where the liability franchise is very strong and is actually getting stronger, and where the capital position is strong, we are comfortable owning those names as valuations have also normalized, and in the medium term we believe those banks will bounce back. So banks is still tricky. I think Q4 and actually more than Q4, Q1 earnings will give you a better picture of how things are shaping up on the asset side, in terms of the portfolio stress.
All right, Varun. Thanks a lot for your time today. That's the view from HDFC Securities. The market is